Hello, Frank. Welcome back to the podcast.
Hey, Sanjeev, how are you?
Good.
Good.
Um, I think we're here to talk about, um, first of all, the meteor
Oh, yeah. Yeah. So
in
this
Boston.
Boston, we collectively, as a metro area, heard a huge explosion in the middle of the afternoon, and everybody was kind of freaked out that their next door neighbor's gas had exploded or something. But it turns out a meteor hit the atmosphere just somewhere off in Massachusetts Bay, and there was this huge sonic boom, effectively, that we all felt. So it was kind of surreal.
Um, that must have been scary.
It was a little scary. I'm not sure this is an adjunct to this conversation, but we are doing a big house renovation project right now, and a lot of the foundations in the building have been removed, basically. And so my wife was like, "The house has just fallen down." Hopefully not. Fortunately,
um, it's been a interesting. Speaking of foundations and sort of the energy transition, it's been an eventful, I would say, 3 years since you and Gokul released the missing middle paper, which was really important to S2G, as you know, Frank, in terms of how we thought of it. And, you know, one of my things is there's so many now missing middle definitions. I'm sure we'll get into this.
yeah.
But just reflect on sort of, since that paper was released, sort of the evolution of sort of the energy transition. How do you see the market evolving?
So towards the end of 2023, we released the paper, The Missing Middle, Capital Imbalances in the Energy Transition. And really what that was an exercise in exploring what parts or what stages of the transition we're seeing a lot of capital allocation, and reflecting on, well, was that really a fit for purpose allocation as it relates to the ability to kind of gestate the really important technologies, concepts, and so on that we need through from earlier stage right the way into truly scalable, bankable infra type opportunities. And the relatively straightforward takeaway was that both the early stage and certainly the late stage in the infrastructure segments were 5 years ago exceptionally well capitalized, but that between those two stages there was a lot less capital available. And that was a real challenge, because what would happen, and certainly I think this has played out multiple times, is that those good ideas that managed to gestate through the early stage would arrive at a juncture where they were not yet ready for prime time, so to speak, in terms of an infrastructure investment or whatever. But they had a shot, and that's really important. And what they needed were investors who could contemplate a return that wasn't a venture scale return, but that was also, a riskier bet than what the infra guys are willing to accept. And that could write larger checks than the typical earlier stage venture kind of consortia could write. And that just didn't exist at the time. Certainly, it was much more limited. Because it was limited, it added a further crease in the whole dynamic, in that the over-capitalization of early stage meant that valuations tended to be quite high. The under-capitalization of the growth segment tended to provide growth investors with a view that they shouldn't be paying as much for these deals. And that caused a lot of friction, and so on and so forth. So, we laid out a data-driven review of the situation. And I think what we did as a collective at S2G was said, hey, there is an underserved opportunity here, where, good companies that are making progress, albeit not quite there yet, can be supported through that revenue growth phase into profitability. And then beyond that, many of them are going to graduate to the large infra private markets, or maybe even indeed continue on into the public markets. Take Fervo as a recent example of all of that. So that was what that paper was all about. And since that paper was released, I think our collective community has focus more on this issue of the missing middle. And there have been various different definitions, whether it's growth equity, whether it's, first of a kind pilot project, debt or equity, etc. But nonetheless, it has become a term in the vernacular that's thrown around to a much greater extent. Now we're 3 or 4 years hence, and Gokul and I have gone through an exercise, kind of stepping back, taking another look at what the market looks like today, and reflecting a little bit more on that core question about the missing middle. But also, as I'm sure we'll chat here, kind of interestingly, we've seen some other takeaways now that I would say are, they're not necessarily double clicks on the missing middle itself, but they're important parallels and adjuncts to that core missing middle question, which I think perhaps are now issues we should also start talking about, because they have some real implications for our ongoing motivation to continue to help support these businesses, because we need to move this space forward and unlock value for our investors.
Yeah, there's so many directions that we could go, but I want to start with the original one on the first principles basis, which is really the highlighting in the 23 paper of early stage versus infrastructure. I think just your reflections, because I know you teach this as well on the early stage side, and you've operated in the infrastructure world. But I was in Singapore in 2013, and I was sort of critiquing how I thought China was dislocating markets with enormous subsidies and infant industry stuff, and it was sort of creating global issues. And my friend was like, "You think China's dislocating stuff? Like the U.S. Federal Reserve is dislocating pretty massively." And as I reflect, zero rates allowed two things to occur, and perhaps even negative rates. And as you were writing the first paper, I think just as a backdrop, just curious. One was, I think, zero rates, in my opinion, led to the growth of infrastructure as the modern bond, effectively. And so there was a ton of financing that occurred because people were searching for yield that they were not getting in the sovereign treasury markets. Two, as again, zero rates and negative rates, if you remember during COVID in 2020 and a little bit 21, that led to, I think, a lot of frothiness in early stage in 22 and 23, which on hindsight are seen as very bad vintage years across asset classes, particularly in venture. If you reflect on that, and now last week, the 10-year spiked to a 2007 high, the yield curve is the yield curve. Just can you reflect on sort of how infrastructure and early stage, in your opinion, have evolved? Because, and then just in the time you wrote the paper.
Yeah, I mean, we've seen a major reset between, when that paper was originally first published and where we are today. As you said, that has been driven by how the base rates have evolved. So 5, 6, 7 years ago, the in a much lower rate environment, the renewable business, specifically in wind and solar, were at a phase, I think, in growth and development, certainly here in the States, and I was involved in this myself, where the low rate environment, coupled with the relatively kind of intense competition at the time, was really driving value, prices for the commodities way down, and people were really leaning on and reliant on very low rates in order for project returns to be, just about acceptable. When in reality, I think if you step back now and reflect in the cold light of day, that was a very poor kind of risk return kind of trade-off in reality. And you've seen the impact of that on a lot of the pure play renewable players, and how the public markets, for example, kind of have really stepped away from that space. And there's been a general reset on expectations around what return expectations should look like at the infra end of things. And with the base rates rising during that period of time, it's made that challenge even greater, right? You're dealing with a rising tide, and on top of that, rising tide with respect to interest rates, and then on top of that, you had supply chain constraints and so on, and that really kind of has led to a lot of pain. I do think, Sanjeev, we're kind of for the larger infra clean energy space, there has been a degree of a reset has taken place, right? And we're coming out the other side, and people have a different expectation now around what what the return profiles need to look like, and what these commodities are going to ultimately cost. Interestingly, of course, we've also had this very interesting dynamic with the upturn in demand for electricity and expectations around AI and so on, and that has kind of led to a more buoyant power market and so on, and that's reframed what the performance envelope needs to look like, I think, for infrastructure assets. Now, reflect that back into the early stage space. I think in 5, 6, 7 years ago, with respect to early stage clean energy, there was a view that's colored by low rates and so on, and an expectation that the price of power was going to continue to fall.
Yeah.
That a whole host of electrification modalities to kind of address cleaner sources of molecules and commodity products and so on, that those tech all had a chance of kind of getting there, or at least that the key techno-economic analyses at these lower input cost expectations and this lower cost of money regime could get you to a place where some of these tech
electrify everything
could be interesting. Absolutely. And I think, right, in the last 2 or 3 years, Sanjeev, things have changed very significantly, and unfortunately for a set of those technologies, in the very much in the wrong direction. In that now you've seen the price expectations for things like power, I think, have changed. Maybe not dramatically, but there's certainly, I think it's difficult to countenance, the notional a lot of free electricity hanging around, because that's just not where we're at right now. And then the base cost of money flowing into, challenging infrastructure, long life infrastructure, has also increased meaningfully. And all of that has kind of moved the needle. And I think those true tough technologies face meaningfully tougher paths now forward over the next 5, 10 years. That's the reality.
Yeah. Before getting to sort of the new report and the data that revealed, I have 2 hot takes for you, and tell me how wrong I am, or whatever. This was a prominent regulator that I think the notion was these zero rates or low base rates, coupled with some of the renewable incentives, created an atmosphere where it effectively deflated or kept power prices low. And so when we think about power price increase with the data load, the data center load, etc., it was like not artificial market, but it was like a very dislocated market.
An artifact of the market, certainly. Yeah,
exactly.
Yeah.
What's your view on that hot take?
Yeah, I mean, I think that there's clearly something to that. I think to step back on the broader question of electricity price trajectory, and I think we do this a lot at S2G. We think about the components of the cost of electricity. There is the capacity component, there's the grid component, and then there's the energy component. Certainly on the energy component, if you have very, very low rates, and you have on top of that further subsidies, as you have with wind and solar, with the ITCs and PTCs, you are going to be able to bring on very low cost LCOE megawatt hours onto the system. And I think we've done that. And I think now there's been a degree of reset in that space over the last while. So that prominent regulator, if you wish, I don't think it's difficult to argue against that point of view. I think that's fair enough. So I think that's adding some upward pressure to the affordability issue. But I also think it's important to acknowledge that a lot of the the overall affordability challenge that's now emerging is also coming about because in order to support the system to deliver on all of this new demand and so on, we are just having to invest into the bits and pieces, the wire and so on, in a way that hasn't previously been the case, and that is not cheap either. And so we have a little bit from column A and a little bit from column B converging. And I think
Second
the
hot
long
take.
thing is like power is going to be a little bit more expensive, and that's we just have to realize that,
And that could have happened much earlier had it not been for base rates and
I
some of
think
the
that's absolutely
policy.
true.
Yeah.
And maybe one final crease on that is I do think if we, if as I believe we will see over the next few years, the U.S. gas market couples more aggressively upwards towards the European LNG
The
land.
TTF. Yeah.
I think that there will be some further pressure coming out on power prices because of that.
Yeah. The Henry Hub to TTF sort of conversion story. The second hot take, this one for a prominent investor. I'm just recycling other people's hot takes today. I'll get to my own later. It was like an early stage. So let's get the early stage was you either lever to electrify everything.
Yeah.
Now, if you're not levered to AI and the power load story, it's very hard to catalyze capital. If you're, what is your view of that hot take?
Well, I think, I think very much that's probably very fair. I think the capital allocator class, if you wish, that was, that they're naturally looking for where they feel like the growth opportunity is going to be, and I think that, and it's unquestionably the case that where that growth opportunity and where all of those challenges are in the nearer term certainly are no longer related to this need for the decarbonization of long-term commodity manufacturing. In reality, much more focused on the very near-term need to get more data center capacity online, to run that as efficiently as possible, to do more with less, et cetera, et cetera. And so in our world, I think, Sanjeev, I'm sure you'd agree with this, we see real scarcity now, that scarcity value around things like transmission, those assets. There's a lot of interesting opportunity, I think, on services for supporting the system as a whole. I think there's probably a lot of interesting opportunities too in and around the data center and its operation, quite aside from kind of getting into the actual technology in the racks and so on. And that's what people want to talk about. That's what allocators are focused on.
Totally. Okay, so tell me why you updated this report and kind of some findings.
We've written an update to the missing middle paper, and it started off as an exercise again in just kind of reviewing how that original concept, the fact that there wasn't as much growth equity as we felt was necessary in order to continue to support those successful early companies, how that had evolved. And so we have taken a snapshot of the past 5 years in the energy, let's call it energy transition broadly defined market, private market here in the US and in Europe. And we have gotten into the nitty gritty to kind of understand what's happening in terms of how capital has been raised, the stage which that capital has been raised, and then how that capital is being deployed into the market, and what the realizations have looked like from that in terms of value back to investors and so on. And there are a couple of very interesting, I think, from our point of view, insights that have emerged.
Mhm.
The first I would say is that although people have spoken much more about the missing middle, a la what we discussed earlier on during our chat now, we haven't really seen that much more money coming in specifically to well-disciplined growth funds.
Right.
What I will say is that we have seen, I think, a lot more people speaking about making growth investments, but those growth investments and that allocation into the growth investment, I think we would not define that as growth. We would define those as very large venture investments, actually, because a lot of that capital has continued to go into businesses that are truly pre-revenue. And so there's a nuance to that. It's not good enough for us necessarily just to say we are growth investors. The point about the missing middle paper was we said there was a lack of capital available to revenue generating businesses that were in that early growth phase, not businesses that just needed a very large check. We certainly see some of that behavior. The other thing that's interesting is that a pattern, and this was probably the case actually several years ago as well, but we weren't really looking at it at the time. But if you look at how funds focused on different stages, how they have come together, what you'll see without any, unexpectedly, of course, is that, funds that are targeting, infrastructure, certainly private equity, and even the true growth funds, there are very, very few small ones, and they tend to get quite large. What we would have kind of expected was that for the earlier stage funds, you'd have lots of small funds and very few large funds. But actually, over the last 5 or 6 years, what you've actually seen is that a very significant amount of the early stage capital has actually been raised into large early stage focused funds, and some of them being very large. And in the paper and in the analysis that we were presenting in this Illusion of Crowds paper, we've drawn on that thread because we believe there are some challenges that have arisen because of that pattern. The first is, and we know this well, Sanjeev, in terms of our own earlier stage work, those large funds, they have had over the period of time a challenge in finding deals to do that kind of intersect with good management of $1 billion fund. If you have $1 billion fund, you need to put that to work within a reasonable time frame, and ultimately you need to write reasonably large checks. And that need to write large checks early on limits very substantially, I'd argue, the envelope of investable opportunities that exist for you. And we see that. So in the paper, we give an example that 1.7% of the early stage deals within a 5-year period, they together accounted for 45% of the total capital deployment. And when you drill into those 1.7% deals and who's involved, it tends to be much larger funds. And there are two elements to that. The first is, of course, well, there are just some deals that require a lot of money. And this is coming back to some of these more capital-intensive deals and so on. But there is another question as to kind of whether or not it's just that these large funds have to focus on those larger deals in order to move the money out into the market. Because the other 150 smaller funds that are out there, they're out there doing 3,000 smaller deals. And there is an interesting question, I think, as to kind of like how effectively are we rastering the entire opportunity space with that type of allocation. The other thing, Sanjeev, that I think is particularly interesting in this second analysis is that if and as we continue to follow the money, what we do see is that those larger funds, they tend to do a lot of co-investment with themselves within that peer group of large funds. And part of the reason for that is, of course, that a lot of those deals are large deals, and large funds needing large deals can do with the help of other large funds needing large deals in order to support those big concepts that you're going after. Now, what's interesting about that, certainly as I sit in our seat, is that there are implications for concentration, capital concentration in the market that flow from that type of co-investment behavior. It's one thing to have a cohort of large funds all doing relatively large deals. But what is actually the case is that there's a much narrower aperture of companies receiving that capital, because the spectrum of larger funds, they tend to heavily co-invest with each other actually into a smaller set of companies. And very interestingly, as the data in the paper will highlight, those co-investment deals, they tend to be meaningfully larger, on average about twice as large as the deals when one of those funds does not co-invest with one of its peers. So that is an interesting take from our point of view, because the implications there are that there is perhaps a slightly opaque capital concentration mechanism playing out within the early stage. And if that concentration is too extensive, I think there may be questions about whether or not we are fully rastering across all of the opportunity set that needs capital, or that has, that may have a solution. And then, of course, there are implications there for the LP and the allocator community, because you could find yourself in a situation as an allocator where you have a diversified allocation into many of these leading investors, but actually your actual allocation is much more heavily concentrated within a few individual companies, because all of these funds are invested in those similar businesses. And it's very important to point out there's absolutely nothing out of order with all of that behavior. From an individual fund point of view, everything that we see in the market makes complete sense. But in the paper, we framed the analysis around an interesting framework called the wisdom of crowds by James Surowiecki. And the whole point about the wisdom of crowds framework is that the notion is that a large crowd, if behaving or operating around with certain parameters in place, should be able to deliver a more thoughtful outcome. And in our business, as we try and move, energy transition investing forward, we need lots of that. And what we see in reality is that some of the parameters that constitute wisdom of crowds behavior are not being met, because we're seeing more concentration, because we see a lot of this co-investment behavior and so on. So that's a second order issue for sure, but I actually think it's a very important one right now. The other issue, Sanjeev, and it comes back to our earlier conversation about growth versus early stage, is that though there has been a lot of quote unquote growth rounds during the period, the reality is that a lot of that capital went into companies that were, as I said, not actually in the growth stage. They were just very large venture plays. And there is another question there as to kind of whether or not the market has fully moved into delivering growth investing versus speaking about writing larger checks into what remain relatively risky earlier stage opportunities.
No, I think I love the paper. I'd encourage everyone to read it. I think before getting into the paper, maybe just talk a little bit of wisdom of crowds for people that may not follow that as a framework.
So the wisdom of crowds. So financial markets are in their purest form are often seen as a good example of the wisdom of crowds framework, which is a concept where collective judgment, the market, works best if four particular conditions are present. The four conditions are that there's diversity of opinion, so lots of different folks with different opinions, which all obviously makes sense. Independence of judgment, so view that as independent underwriting. Decentralization, so that can be many different things, but breadth is useful. And then an effective mechanism for aggregation. So how does all that come back together? And that comes back together in price formation, for example. So the notion there is that if you can create a market framework where those features are all present, that market should do a better job than any individual participant should be able to on their own or subgroup of the collective, because nobody has perfect information, but we should have little intersections of all the sets effectively to deliver a better outcome. And that's what the wisdom of crowds is about. And that's, I think, a question now as to kind of whether or not we're really seeing that in the market.
Yeah, I think you could argue, and this is going to be a fun hot take between the two of us, I think.
Yeah.
Because I think I would argue that exists, but what I would argue is we have a denominator issue in a lot of these asset-intensive, capital-intensive categories. The bug is the asset and capital intensity of getting these things from X to Y in revenue, EBITDA, megawatts, gigawatts, whatever you want. And I think it could be argued it's a bug or a feature, but and I think then it's sort of like, all right, I hear the argument. We kind of have to pick one or two of these and just go, mainly because of the original thing that you identified in the first paper, which is this gap between early stage and infrastructure exists. And so how do you attack it? Does that argument make sense?
So I will say it does. No. So this is a nuanced subject, right? And,
absolutely.
And we also need to be very realistic. With that said, there are relatively straightforward elements in kind of how our markets are structured today that lead to the type of evidence that we're seeing. And there's a question, I think, for the market, if we step back a little bit and say, is there a slightly different approach that one ought to take in order to kind of mitigate some of the challenges that arise? So the first point is that the first thing you said there is, like, obviously you need to get to a certain scale to move a certain vehicle forward.
Yeah.
No question. I think what we see, though, is that in today's market, particularly the fact that you have some very, very large early stage funds, that you are faced with a need to almost pick winners earlier than you would like to.
Yeah.
And I think my own instinct here, and this is much easier said than done, but my own instinct would be that we would be better off as an overall market structure if some of that capital that was ultimately allocated to these true large early stage funds, that market kind of spilled over a little bit into what I would describe as smaller growth stage funds or medium-sized growth stage funds, who would come in and intersect with these opportunities at a slightly later point in their gestation. So allow that early stage capital to explore the spectrum a little bit more broadly, not crowd in too much capital too early, and then with some initial progress, perhaps see some of the growth stage come downstream a little bit to kind of pull the promising opportunities up into the growth category rather than the other way around. The other way around makes it very difficult. I think it's very challenging, if you have to make a big bet, at the true seed stage on what is going to be an exercise that's going to take several years just to get up and running, let alone, probably a decadal kind of time frame in order to really scale. So I think there's something there, Sanjeev,
Yeah,
about just how the capital as a whole is spread, and the way we're, it's just a feature of today's market that's that's
I
how.
totally agree. It's being jerry rigged effectively. I think what my takeaway a little bit was, if you're an allocator, if these things produce alpha, then these vehicles frankly need to be much, much bigger so that the loss ratios can absorb
Yes.
that.
Yeah.
Number one. Number two, absent that, there's a lot of indexation happening because those big vehicles don't exist.
Yeah.
That can absorb loss ratios in the growth side. And as a result, that indexation almost leads you to like a beta that's with a somewhat narrow standard deviation because of the 1.7% and the 45% kind of issue. And so my
Absolutely.
message to the allocator class would be, we need a much bigger boat to absorb the loss that naturally happens in these things, or just be aware that effectively you're effectively creating a beta with a somewhat narrow standard deviation. Does that make sense?
I think that's very correct. So your point on the the 1.7% of the kind of individual
Yeah.
deals soaking up 45% of the early stage capital. Really, I think all of that capital should not be effectively early stage capital. I think a lot of that capital should actually be coming from let's call it a late venture growth stage versus an early stage one, because you would like those funds then in that growth category to have more mature things that will allow for the absorption of some of these bigger checks with the very real chance that they go slightly sideways, and that doesn't really have really challenging impact on the performance of those funds.
And absent those things, your
I
reliance.
also
Oh, go
say
ahead.
one final
Yeah.
thing on that, Sanjeev, that's really important is the crowding of capital behavior that we see is taking place at the wrong time.
Yeah.
So coming back to those bigger funds, it would be better to have slightly later stage funds where then you're having that co-investment coming along, because you have kind of taken the edge off that really risky early stage, and you have a shot now. The alpha beta ratio is a little bit more benign than it is right now. I'll argue that the real risk ratios are very, very significant
Yeah.
for the overall sector because of this concentration.
And I think if it's not an index, the alpha probably comes through with who gets access to the public capital markets, and they are effectively, you're handing the baton to them.
Yes.
And then it's a big bet on, when is this musical chairs gonna change? And having lived through March 2000, October 2007, August 2022, all of those are peaks in the market that in my financial service career. If you were April of 2000 or September of 22 or November of 2007, you're on your way to the other side of the peak.
Yeah.
And you didn't get the baton handed to you with a large volume of capital to go execute the business plan. So, good luck with the musical chairs is the concern.
We in the paper we kind of dive into the proof of the pudding is in the eating, I guess, as they say, right?
Yeah.
So we dive into the actual kind of the tangible. So there's value creation, sure, in terms of moving businesses through rounds and larger rounds and so on.
Yeah.
But the real question is, what sort of kind of liquidity is coming out the other side?
So value creation versus value realization.
Completely. And, we remain in a situation, and sure, this is a 5-year snapshot, but by the way, we could do the same thing 5 years previous and same story. So we have a situation where the segment is absorbing 3-4 times more money at the moment than collectively than it is unlocking in value realization. And I think that even, and by the way, that's even including, you know, very notable successes, which is great. But it just highlights that we have a lot of work to do in kind of bridging from where that capital allocation seems to be going to a point where we're able to realize whatever the value outcome is out the other side, whether it's into the public markets or whether it's into an M&A transaction or whatever.
One of my concern is like even the Halo trade that's levered to the AI story is going to come under some um, friction. Even some of the most prestigious sort of proselytizers of AI are starting to note that we may be going through a similar curve of hype curve, trough of disillusionment, and then actual value creation. And if it goes through the trough of disillusionment, even some of the things regarded as Halo, you know, could be on if it's levered to AI, which going back to start of our conversation, so much of this is still levered to an AI story on the power and compute side. That if at the end of the way those tokens don't deliver ROIC like immediately or the next year, it starts to unwind fundamentally.
I think you know, there's our day job, Sanjeev, obviously. We're very keen on, you know, being able to take advantage of at the moment in time on the cycle and so on. And we're there, you know, we're certainly in a moment of time. But I think we step back a little bit, again, speaking about the overarching challenge, I suppose more what our careers are dedicated to. And that is like implementing the successful, sustainable transition. We got to keep the lights on too in between. That's all important. But I do think like this paper and some of the reflections that it, you know, draws out kind of come up in that respect. Because right now, you know, we are certainly in our space seeing a halo effect for certain solutions, you know, that kind of really scratch a very urgent itch. But all around, I mean, we all understand when we look at the fundamentals that, you know, these fundamental commodity producing businesses are just exactly that. And there's an acceptable yield that they're going to produce. And, you know, what is implementable, what's defensible, etc. So I'm a little bit concerned about
I think the day job versus I think they're all the day job, if you will, in terms of this paper. But I want to go a little bit maybe orthogonal with you and random. You know, when you and I first started to get to know each other, I was excited that you wrote at the MIT Energy Institute the shale paper, which I thought was a seminal piece in my growing up in investing in the energy world, because that unlocked a whole wave of CapEx booms that, you know, effectively today you sit here and said, okay, like part of the reason the US is, and then you wrote a paper around sort of early stage climate tech and the learnings from that. And then you wrote Missing Middle. Like, do these papers help you, like, when you write them and, you know, going back to, you know, that seminal paper on unconventional shale, and then to today, like, what is it when you sit back and what does it allows you to do as an investor, as a company builder? What do these things give you in terms of efficacy as you think about the day job?
So I think, I mean, there's always, it's, that work is always very helpful in kind of helping you understand how little you really know or how little you can control, right? And I would say that going back to the future of natural gas as a starting point, what that paper really was all about, or, you know, was focused on, was obviously what shale would do. And shale has transformed the energy landscape in the United States, not just in the gas front. Obviously, it's transformed power, it's done all sorts of things. But more importantly, it's kind of rewired the entirety of the kind of global macro energy flows, because, you know, at the time, as we pointed out, even if the United States didn't export gas, the very fact that we could export gas altered all sorts of long-established geopolitical frameworks, market frameworks, for example, like the Japanese crude cocktail used to be the only mechanism via which LNG was traded, 20-year long-term contracts linked to oil prices. Now there's a big spot market for LNG, et cetera, et cetera. Now, what I also learned was that, and in that study, we didn't look into it, but we subsequently looked into it, that a tremendous amount of equity value was destroyed here in the US through the ramp up of the shale boom. Many operators lost a tremendous amount of money because it's not so straightforward to, grab the kind of
You're doing the linkage that I was going to do, Frank,
and hold on to the value.
Yeah.
And so the learning, and this is like several times, the learning, I reflect on that today, Sanjeev, and I think you and I, we talk about this all the time. The learnings there are that, yes, the world has changed. But just because the world has changed doesn't mean that everything that's leaning in to target that space is going to work. And if anything, you need to be extra careful not to kind of get swept away with it and be very, very focused on your underwrite to ensure success.
And that is the art of what we do. I think it's like shale was underpinned by secular themes and trends. There was a ton of collective and individual wisdom there that financed it. But not every great business or secular trend leads to a good investment outcome. Is sort of the through line that I've seen repeatedly in my career. And I think that is the art of this, is when is it phenomenal business, underpinned by phenomenal secular forces.
Yeah.
But the investment side is much more cautionary tale, much more an art of timing, art of approach, art of where you pick your zip codes in the neighborhood you participate in. And I would imagine that's a through line for you on the unconventional space as well as sort of the clean space.
No, 100%. And yeah. I mean, we've often spoken about this. It's also challenging considering we try to, we're often trying to invest in the vanguard. But I mean, like, history will tell you that typically it's the second or third owner of the asset or solution that can really make money. So, the world has changed, the markets have changed, the technology is there, but how our timing with relation to, being in the equity and unlocking the value, how that plays out is certainly more nuanced.
Well, congratulations on another great paper. It's under it. I think you guys do a great job. Just be data driven, and I think it's an important paper for the public capital community, the capital markets, and the public side. Obviously, for allocators, for company builders, for investors, and I think there's real merit in sort of looking at the arc of history and the moment we find ourselves in. So, thank you for publishing it.
Yeah, thanks, Sanjeev. I think, you mentioned, like, we like to be data driven. We're laying this out. I'm not sure, it's complicated space. But I think, the more we can as a collective community do to kind of understand some of these trends and kind of think about how we can tweak and course correct gives us a better chance to do the two things that I think we're all about. And in no particular order, really help drive a true energy transition, because that's necessary. And also, of course, create real value for our investors, So, hopefully folks will like it. I think that at least, and even if they don't, I hope that it helps to spur some conversation.
Thank you, Frank.
Thank you, Sanjeev.
To learn more about today's discussion, download the full paper, The Illusion of Crowds, from the link in the show notes. Thank you for tuning in to the S2G podcast. If you enjoyed this episode, please subscribe, leave us a review, or share it with a friend. For more information or to connect with us, check out s2ginvestments.com.